The next topic in this course is corporate level strategy. Now, corporate level strategy is distinct from business unit level strategy because corporate level strategy focuses on the relationship among the different business units within an overall corporation. Corporate level strategy would focus on, for example, how a company decides what combination of different businesses it should be in. Corporate level strategy also focuses on what is the relationship among those different business units. How do they work together? Do they share common resources? And also, how do they execute the overall corporate level strategy together? Now, I'm going to start our discussion of corporate level strategy with a little bit of a puzzle. I'd like you to think about the following question. You can imagine a continuum of different types of corporations. And at one end of the continuum, shown here on the left, would be corporations that have a very narrow scope of business. For example, single business corporations, where over 95% of the revenue comes from one industrial category. At the opposite end of this continuum, at the opposite end of the spectrum, you can see completely unrelated diversified companies who have a very broad scope of businesses with no more than 30% of revenue coming from any one industrial category, and with the business units not sharing any common resources or skills. Now, in between these two extremes, you can think about the related diversified corporations. And those companies, like the unrelated diversifiers, would also have no more than, say, 30% of revenue from any one industrial category. But unlike the unrelated diversifiers, the related diversifiers would have business units that share in common certain resources or skills. Now, the question I want to pose to you here for the puzzle is, what would you expect to be the relative performance ranking of these three different categories of companies, and why? Which one should be number one in performance? Which category should be number one? Which category should be number two? Which category should be number three? Among the single business, related diversified, and unrelated diversified corporations. Take about, let's say, 20 seconds now, and write down your answer and the reasons for it. Okay, now this question that I'm posing for you is a question that has been examined extensively in the research literature in strategic management. There have probably been at least 75 or 80 different studies looking at different versions of this question, trying to answer it in slightly different ways using slightly different data, and so on. But all of these studies come up with basically the same basic results. I mean, literally dozens of studies coming up consistently with the same basic answer to this question. And that is as follows. That among these three different categories of corporations, related diversifiers tend to perform best, and unrelated diversifiers tend to perform worst. In between those two extremes, the single business companies are sort of moderate in performance. Now let's think about why this is. Well, I think it's fairly straightforward to see why the unrelated diversifiers would be worst. They don't have a core capability or core competence to their company. There's nothing that's being shared across these business units that is distinctively better than what competitors can offer in the competition to any of these business units. So because there's no shared core competency there, there's not much opportunity to create wealth, basically. The single business companies do have something that could be labeled sort of a core competence to what they do across the entire company. But they may not be applying it widely enough for them to get the maximum benefit out of it. Think, for example, about a company like Disney. If they just produced movies for theatrical release and did not produce television shows or videotapes or theme park rides or merchandising, right? They would have spent a lot of money to build up a core resource on their animated characters, but they wouldn't be exploiting that resource as effectively as they could across the wide range of different industries. So single business companies are not the best performers overall because they may have a core competence to what they do, but they do not apply it widely enough to get the maximum benefit out of that core competence. And that's what the related diversifiers do. Related diversified companies tend to perform best because they do have a core competence to what they do across their entire spectrum of business units. But unlike the related diversifiers, they do have something that they do well. But unlike the single business companies, they do try to exploit this core competence across as wide a range of businesses as they can. They don't try to exploit it across a wider range of businesses than they can, otherwise they would become unrelated diversifiers. Okay, so let's think about how diversification can create value. Let's start with the related diversifiers. Now, related diversifiers can grow either by acquisition or through internal development. But what's the point of that growth? The point is to help the corporation as a whole develop operational synergies across the business units by exploiting common resources and common capabilities across those different business units. And this makes the different business units highly interdependent, often in complex ways. So for a related diversifier, the corporate headquarters office is typically involved in the operational details of business units to a very great degree for the purpose of maximizing the coordination across those different business units. Now, some units within the overall corporation are typically called upon to sub-optimize their performance for the greater good of the whole in a related diversifier, not in an unrelated diversifier, but in a related diversifier. And so what you want to do in a related diversifier in terms of evaluating the overall contribution of the corporation as a whole to the business units is you evaluate the corporate office by measuring the value of the synergies that it created. To what degree is the whole now greater than the sum of the parts as a result of the involvement of the corporate office? That's the critical question you want to ask about the value of headquarters in a related diversifier. Next, let's examine how the best performing unrelated diversifiers attempt to create value. We do have to acknowledge, as I mentioned on the previous slide, that unrelated diversifiers on average generate less value than related diversifiers. But here we're not talking about the average. We're talking about the best performing unrelated diversifiers and how they attempt to create value. Well, first, unrelated diversifiers tend to grow primarily through acquisition, not so much through internal development, mostly through acquisition. And what they try to do is, in effect, they try to beat the market. They try to outthink the stock market. They will aim to develop private information or private knowledge that will enable them to value firms that are available in the market, to value those firms better than the market can. They do this in order to try to find bargains, and one thing that they will do is once they think they've found a bargain, they will specifically try to avoid getting into a bidding war because they want to avoid overpaying for these firms. They tend to run these business units autonomously once they're acquired, and then eventually restructure and sell them. But the problem with this unrelated diversification strategy is that it depends upon finding bargains. It depends critically on the unrelated diversifier's ability to value firms better than the market can, to be smarter than the market. And that's really hard to do these days, especially as the market for corporate control has become more efficient in recent decades. It may still work in certain developing countries with relatively inefficient capital markets and inefficient markets for corporate control. But at this time, by this point, after, we're now several decades past the deregulation of securities markets in the United States. By this point, Our securities markets and our markets for corporate control in the United States are fairly efficient. And so this unrelated diversification strategy is a harder and harder strategy to pursue in the United States, and indeed in most countries around the world, once they deregulate their financial markets and their markets for corporate control, and those become more efficient and more competitive. But again, there are still some developing countries around the world with inefficient markets for corporate control and inefficient capital markets where this game can still be played.
Okay, so to briefly recap, let's summarize how the best performing related diversifiers create value and how that's different from the way that the best performing unrelated diversifiers create value. The related diversifiers tend to grow either by acquisition or by internal development. They develop operational synergies through common resources and capabilities. The business units are kept interdependent. The corporate office is deeply involved in the operations of those business units in order to maximize their coordination. Some business units are called upon to suboptimize their performance for the greater good of the whole. And it's important to evaluate the corporate office's contribution by measuring the value of the synergies that's created. The unrelated diversifiers, on the other hand, usually grow only via acquisition, not by internal development. They do this by developing private information or private knowledge to value the firms that they acquire better than the market can. They look to find bargains and avoid bidding wars. They let those business units run autonomously, eventually restructuring and selling them. But the downside, of course, for unrelated diversifiers is that it's really hard to find those bargains, and it tends to get harder and harder as the market for corporate control becomes more efficient, which may be less of a problem in developing countries that still have relatively inefficient markets for corporate control.